tenía mucho. ¿Hiciste corte? Porque
No,
apenas la mide.
me lo corté, creo que como en marzo.
Pues de mira bonito.
Gracias.
Qué elegante.
Sí, pero esa, antier dije, ay no me lo quiero secar, solamente me lo lavé, pero todo rascado.
Ya, yo sé que le da feo.
El volumen.
Si no, se ve todo.
Sí, cambio las sombras.
Era más fácil, ¿verdad? De la nieve,
Gracias. Mi esposo me dice, cuando vamos a la iglesia, me dice, ¿ya te vas a ir a alistar? Digo, no te preocupes. Una hora yo estoy lista.
Okay. All right, we're going to go ahead and get started because I know everybody's super busy. So
Yeah.
what we wanted to talk about today is just kind of a little bit about Mortgage Express, plus we want to make sure that you guys know how to overcome some of the objections that buyers may have to why they can't purchase or why they think they can't afford a new home, they don't have a down payment, or they can't afford things. So this will give you a little bit of information to maybe overcome some of those objections. So this is our team. It's Hadia, David, and I. We're here in the office. David's in the Palmdale office most of the time, but you can always get in touch with any of us, and I'll be happy to help you. And we've been in Keller Williams AB's in-house lender since 2003, and we're here to provide you guys with support. If you need flyers, if you have questions that need to be answered, if you have a troublesome escrow that's needing to close and you don't know what's going on with the scenario, come on over and talk to us. Maybe we can give you guys some ideas on what might overcome. Even if we're not doing a deal, we can still maybe help you with some ideas to overcome whatever's happening that caused the deal to stall out. Okay, so convenience. We do have a Be in Touch, which is our management system, our client management system. You each will end up having a portal. It'll tell you what stage your loan's at. It'll keep track of all your clients. It actually will email them co-branded information for you for the next years to come. So that kind of keeps everybody in touch, and when they email us or when they say something back to us, because we are continuing to send them birthday cards or whatever letters, your information is attached to it as well, so we know which agent belongs to that client, and you guys have another deal or another referral, maybe their move-up buyer or whatever they're needing to do. So the Be in Touch system is really neat for us. So CalHFA, this is one of the down payment assistance that's the easiest to use today. What we're looking at is that they're single family homes, they're not for investors, it provides first time down payment assistance to first time home buyers, but also it can help out with interest rates, closing costs, and not just the down payment assistance. So one of the things that people think with the CalHFA is that it's a government agency.
Like FHA?
Correct, yeah, but FHA, even at that, their revenue comes from their mortgage loans, so CalHFA is not funded by tax dollars. They are making money off of their loans. They are self-fulfilling. They do make their own money, and they're, providing a service, and they're not using tax dollars to do it. So they're getting their own revenue through the mortgage loans that they do. So there's two types of loans with CalHFA. You can either do a conventional type of loan or an FHA loan. So they set their rates though. They're not just the normal rates that we pull up or each individual lender. The rates that you're using on a CalHFA loan are set by CalHFA. They have them on their site. You can pull them up there. So you've got the conventional, which is the CalHFA, and the Cal Plus. And then you have the government insured, which is the CalHFA FHA, Cal Plus FHA. There is an energy efficient mortgage, which is the Cal EEM grant. And then you have the CalHFA VA, which is for veterans. The Cal Plus FHA loan program and the ZIP is what is the plus. So whenever you see the Cal Plus, that means there's the ZIP program on there. There's a 2% or 3% of the first mortgage that they get towards your closing costs. So that doesn't have to go towards down payment. That is going towards your closing costs and your prepaids. Prepaids are your homeowner's insurance and property taxes. can't get money back. If you get to the end, they won't get any of this money in their pocket. It'll be applied towards a principal reduction. And you cannot use it to pay off borrower debt. The two types of down payment assistance are the My Home Assistance and the Schools Program. The My Home will help with closing costs and down payment. You can receive up to 3.5% of the price of the home. Payments are not required until the buyers refinance, pay off, or sell the property. So when they go to do that, that's when they're gonna have to pay back the money that CalHAPA gave them to purchase their home. So the payments are deferred, but there is a junior loan on it. It's not like it's completely forgiven. It stays there silently on the title until they refinance or sell the house. And it can be used towards the down payment and closing costs. So if you have partial down payment, we can still get this and use it towards the closing costs for the down payment. The school program is really cool because they changed it. It used to be for distressed schools, now it's not. Now teachers, admin, district employees, staff, K-12 public schools, charter schools, and county continuing schools. They do have to be a first-time home buyer, and they get less than or equal up to 4% of the purchase price that can go towards the down payment and closing costs. So any teacher, administrator, or pretty much any school employee can get into this school program now. And these are the two down payment programs. And like I said, here's the school teacher, any K through 12 public school, administrators, other employees, and they even said that staff can take advantage of it. So there's pretty much, if they're employed by charter schools, public schools, they all qualify. So again, this program, it'll stay there as a silent second until they sell their home, refinance, or pay it off. That's when they need to go ahead and pay this one off too. So these are the pros. They do have, and a little bit of con. So they do have to meet a credit score requirement, but the credit score is not, that high. The income limits, LA County is 128,300. So, you've got a 640 minimum credit score and you've got 128,000. I mean, that pretty much gets everybody in there. It has to be their primary residence. One of the buyers has to be a first-time home buyer. The con to this one is it does cost $99 because you have to use their home buyer education. So it will cost the buyer $99 for the home buyer education. The down payment programs do require the first-time home buyer, and the ZIP and the FHA, you can't have a non-occupant co-buyer for the closing cost assistance. So in property eligibilities, any single family residence that we're looking at, condos, PUDs, sales price limit is $765,000 in California, statewide. So 5 acre maximum. Some accessory dwelling units, like the granny units, second home, mother-in-law units, they call them a lot of different things, they can be allowed. Has to be a double wide manufactured home. FHA does not allow leaseholds. Does everybody know what leaseholds or land trusts are? So there's some places that are more towards Oxnard, I think was the last ones I dealt with that, where they actually had a government leasehold on the land itself. They're like 40, 50 years and then they have the single family, but you actually don't own the land. So the land is a lease. And they're government leaseholds. So FHA doesn't allow that because they do expire at some point. The interest rates on these CalHAPA loans, they do change daily. They're posted on CalHAPA's site, so we do run into that. But they do have really good rates, so that a lot of times helps us out. We need to have 3 years tax returns to prove that they haven't had an ownership interest in another home. If somebody inherits a home, and so but it's not here, they don't live in it, they've inherited it, but it's been rented out, they actually don't consider that home ownership. So we can kind of get around that because it was not an owner-occupied property, and they're trying to buy a home. Their job's out here or whatever, so that doesn't wouldn't necessarily count. We do need pay stubs, bank statements, and 2 years of employment history, which is pretty standard for all the loans. The energy efficient mortgage grant program's a little different. They do have a fixed interest rate, but you have to get a HERS report, so they're kind of tricky because you do have to have at-home energy. This one's not, if somebody's going to do more of a refinance, this might help them, but it's more of somebody making improvements or that kind of a thing to their home to save on costs. The cons to the CalHFA, 45% max DTI ratio. This is the part where we do find some troubles. It has a 640 minimum FICO score. They have to get a 1-year home warranty protection plan. We can't do manual underwriting, can't do non-traditional credit. The FHA manual underwriting is 660 credit, but then you have to drop the DTI down to 43%, and usually when we have to do that, the DTI doesn't make it. Manufactured homes require a 660 credit score. So when we get, these are the things that kind of kill us when we're doing a CalHFA with the down payment assistance. However, we do have an example. So 350 is a pretty good size home out there. There's a lot of homes for that. The FHA, the Cal Plus, you can use any of those for the down payment assistance. The total monthly payment for that $350,000 home, if they're not gonna put any money down, you can do the down payment assistance at the My Home. You can get the ZIP to cover the closing costs. Say they have a $250 car payment, debt payment, completely. Their payment, total payment of the house is gonna be $2,403. They'll need to make about $6,000 in monthly income.
$6,000
Per month to meet the 45% debt to income ratio. Now that would be less, you're looking at about $4,500 per month if they don't have any other debt. So it does make a difference, but this is just kind of when you're talking to a client, when you're talking to a prospective buyer and they're like, I don't have a down payment. They've got a good job, they've got everything else. They haven't saved for a down payment. They have a car payment, you know, whatever. You can get them in and they can get in without having a down payment. So the only thing that we're really kind of looking for is that 45% max debt to income ratio that's on the back end of them. If they have a lot of credit cards, student loans, auto loans and that kind of thing, if it's excessive, this may not be the program. We could still do the first, but on the down payment assistance, you know, we're gonna need.
The debt, $250, that means the total debt that they have?
Yeah, and their monthly payments in this example.
Yes.
Yeah, so if they have a few credit cards, or if they have student loans, or if they have an auto loan.
It's gonna be $250 max.
No.
No,
It's just an example to say, you know, looking at an average person, you know, in the Antelope Valley, where you're at with a $350,000 house, it's definitely doable. You know, there's definitely these clients out there. There's a lot of them, but the only reason that's holding them back from purchasing
The down payment.
is the down payment.
And they don't know.
Right, and they're like, I don't have any down payment, or they think, well, I'm not low income. So they're not looking at it until they buy their house, or they're not trying to go out there because they say, well, I'm not low income. But, you know, according to LA standard, the 123,000, they do qualify for the income limits.
So the $6,000 income, is that per month?
This would be per month. Now, if you had a house that was less than 350, of course, that'd be less. If their debt was less than 250, it'd be less.
And that income has to be between the two applicants, right? It's,
Yes.
okay.
If there was multiple applicants, but they have to be, both of them gonna have to occupy.
Yeah, the husband and
Mhm.
wife.
Yeah.
So we can't necessarily just plug in the husband without the wives in that case, if the wife wants to be a part of it.
Right. And we would run into the government thing where we're gonna have to include the husband and wife because it is an FHA type program. So on conventional, we may not, but in this scenario, it would be because this was based on an FHA case, and we would have to pull spouse's credit and probably use their income as well.
It's a little interesting there because let's say I come across a scenario where the husband meets everything except for the income. his spouse doesn't qualify, let's say she has bad credit, or whatever reason she doesn't qualify, but
She has the
she
income.
has the income appropriate to meet that level, is that a no-go there? Okay.
Yeah, that would be, because, if we're gonna use your income, we have to use your credit. And we don't get to use credit without income or income without credit. So that does, we do have to have both.
Is that, if the $6,000 in their merit, so the total income
Between both.
would, per month would be equal 6,000 if they're married?
If both of them are making $3,000 a month, then this scenario would work.
And this is a no down payment program, right?
This scenario was based on using the FHA first, the My Home second, and the ZIP for the third, which would be the closing cost assistance. So it actually has 3 separate
Like layers.
layers to it. And when you add all 3 of those together, the borrower usually gets whatever they put as their escrow deposit back.
That's awesome.
Is there any, okay, so you said there's 3 loan assistance that you're gonna be using, right?
Mhm.
Okay, so are all of them, they need to return it once they buy a house, or there's only one silence loan?
Okay, let me go back to,
Yeah.
okay, so these are the types of the loans. So when you are doing the CalHAFA FHA, that one would be 2. That would just be your FHA first and your My Home. When you go to Cal Plus FHA, that plus stands for a ZIP program that adds a third, which is for down payment, or the closing cost assistance. So you do have different loans. They don't all necessarily have all 3 layers, but there are 3 layers that you can have. Now, this My Home second and the ZIP are silent.
Okay.
They're not forgivable, so they don't just go away, but they're silent, so they'll remain on your title. So you make your payments first, like you always do, but if you refinance the house, if you sell the house, that's when they get paid back. So they typically will not subordinate to another first mortgage. They would have to be. Now, the one nice thing about it is they are purchase money loans. So when you refinance and you have to pay these 2 loans off that helped you purchase the house, they're not considered cash out. They're just be considered a rate term refinance, even though we're now making a first loan that's gonna incorporate the My Home second and the ZIP.
Is that something that you disclose to the buyer once they, get that assistance?
Oh, yes, yes. Mhm. And we have to go through there's the disclosures and everything that explains to them that these are there.
Okay.
And, the help's there. They can actually pay it off anytime they want. So if it pleases them to pay it off at some other time, just so they know it's not there anymore, they certainly can.
And forgive me if maybe you went over this, but is there an interest rate attached to the silent loan?
No.
That's gonna be another question they're gonna have.
Yes, they do, and so they do have that.
Great.
Now, we do have, when you bring up the interest rates, so David was gonna be here today, and we actually are having a program that we're gonna be offering that's gonna be adding a little bit extra. So one of the things that we're looking at, and this program is gonna be called the Chenoa Fund. It's got some pretty nice pros and cons. I don't really like the first that they make you have on the forgivable seconds, because the interest rate on the first is gonna be 5.625. So a lot of people are really not gonna like that. But they do come with a forgivable second. So there might be the buyer that we can work with, this might work out for. The really great thing is on that program, if they make 36 payments on time on their first mortgage, the second goes away.
But wouldn't they make them qualify for less because the interest rate is higher?
Yes. So that's the drawback, and that's why I like the pro with the CalHAFA, because the interest rate is a lot less, and they don't. But we do have one program on here that would have a 4.875 rate, which isn't too bad. It's a little higher, but it's not bad. But it has an 8% rate on the second, and you have to repay it. So it'd almost be like, you know, doing an 80-20 financing, but we're actually doing like a 96.5 and 4% second. The same scenario with the 350 purchase price. The down payment would be $12,250. Based on the Genoa fund on the repayable second, they would have a second mortgage that would have a $148 payment for because it's a 10-year term on the $12,000.
What would it benefit the buyer to use that one instead of the other ones that you offered before?
Because their back end ratio can now go up to 50%.
Oh, so the ratios could be higher.
The ratio then allows us to be higher, and that does allow them, you know, eventually you do pay back the second. So this one does have you making a payment on the second, but it does allow you to get up to 100% financing. They don't have the overlays that the other one has, and you can go up to a 50% back end ratio. So there is one program that's coming up here that I really do like. That also, they are offering one that has a second that's repayable on a conventional 97. That one would have a 680 minimum FICO score though.
So there's no PMI on that one, on the conventional?
On the 97 conventional, yes, there is.
Oh, there is. Is it lower than the FHA?
It's the home ready. So depending on their FICO score, the PMI could be better or worse.
Oh.
So anytime you're going conventional, you have hits depending on FICO score.
Okay.
So they call them loan level price adjusters.
Okay.
So the more risky because of their credit score, the higher it is. They do have hits to the interest rate, and they do have hits based on their FICO score.
Okay.
Okay? So is there any other questions on these programs, or how you could maybe try to overcome somebody that's saying, I can't afford it?
Well, the only thing I have in mind is where can I get access to all these slides?
You want all the sides? Well, you have to talk to
Not
us.
through me, I'll send it to everyone here.
Yeah, so then you can kind of have those in there.
I think it's good to have handy in case I'm talking to somebody, you know, pointers I can
Definitely.
bounce off of.
Yeah, and then if you do have to talk about the interest rates or anything, yeah, you have your papers.
Oh, sorry, it's right here? Put it on here? Oh, shoot.
And then my card's in here, Haya's card's in there. But definitely, if you are talking to a client and they say, well, I don't know, you can get me on the phone.
Right.
I'll be happy to answer any questions or help explain any of the programs. It is a lot, so, you know, it's hard to kind of get all of the information at once.
So actually, the program would apply to persons with, the 250 bill payments and, qualifying for the loan according to their income as usual. And no down payment is considered a conventional, it's not came in late.
Oh, no problem. The example that I used, this one is using the FHA.
Oh,
So this one would be the FHA plus the My Home plus the ZIP. So they would come in without anything. And I just added a 250 debt there to just kind of give you a feel for what client you're talking to. Most people have some credit card debt, some, maybe a car loan. That's pretty much equivalent to like a $10,000, $15,000 car loan, depending on what they got for a rate. So, or they've got a student loan or something like that, and they're a first-time home buyer. The extended graduated payment is usually somewhere around there. So that was just kind of like an example, and then you've got maybe a husband and wife, they're making $3,000 or somewhere around there. If they're making less, of course, then maybe we'd have not quite as high of a purchase price, but we've got plenty of those homes. I mean,
and this program, you don't have to be in a certain location like unincorporated or anything like that.
yeah, there's nothing. Now, as far as not having money to purchase, if they're looking at Lake LA area, Antelope Acres, we do also offer USDA. And USDA would not require a down payment, that's 100% financing. They do have very strict debt to income ratios. So their housing ratio, just what they allow for their mortgage payment is 26%. So they really do have to have more income to qualify for that program, just because, but you do have lower home prices for the most part. Some in Lake LA, I've been seeing around 200. I think in West Palmdale, I think mostly they're about 300. Wasn't
Is
like
it
that.
based on price or is it based on area for the USDA?
USDA is geographical. So, pretty much everywhere, if you look at the map for USDA, it is in like Lake LA, Rosamond, Cal City, some, I think if you go far enough on, like Antelope Acres area, they're all, just because it's zoned rural, doesn't mean it qualifies for USDA. So there are those areas. And then, of course, VA, if they're a veteran, we can get them in without a down payment. We can help them with closing costs either through us or through the seller, whichever you do on that one. So we can hopefully get more people to qualify.
You don't have to be first time home buyers.
For the down payment assistance, yes, they do. One person has to be a first-time home buyer. So if there's a wife that sold her house and she doesn't own anything now, but the husband's a first-time home buyer, they qualify.
Question, I heard once where, if somebody bought a home a while back and they haven't made another purchase for a certain period of time?
3 years.
3 years.
3 years.
You know where I was going.
No ownership interest for the last 3 years makes you a first-time home buyer.
Okay.
And a lot of programs will further define that into a primary residence. So if you did, like I said, inherit a property and, you know, sisters and brothers or whoever, multiple people own, if you hadn't lived there and you can document that, you know, that had been your residence, some programs will still consider you a first-time home buyer.
Does the refinancing fall into that as well? As far as like if they refinanced a home within the last 3 years and whatnot, would they, or they haven't?
If, on that scenario, on the,
Yeah.
yes, yeah.
For first time home buyer.
They would still be if they hadn't resided there on certain programs that would allow that.
Okay.
Okay, anybody else have any other questions? On the program? No?
Thank you.
You're welcome. And there's food.
No way.
Yes, we have some snacks.
Awesome. Thank you.
You're welcome.
Before we go, if you could just like sign in real quick.
Oh,
Thank you. I really appreciate it.
Huh? Oh, that was just today? Okay, okay, sorry.
Is that?
Huh? Oh, okay.
Thank you.
You're welcome. Let me know if you have any other, if you think of something later. Please, and thank you for coming. I hope I didn't take up too much of your time.
Now you feel like a ballet.
You just
You
have
want
to
to
be
play
that
Ah,
because of the designation regulations, that would have to have a little bit of hard time or,
you want to get some extra? Yeah, I did.
The USDA is 100% financing, and there's some closing costs. Yeah, it's not, there's no down payment assistance as far as closing cost assistance, it's just 100% financing. It's very much like a VA loan. It really kind of acts like a
Este teléfono siempre lo dejan.
Oh.
Es que hago eso, me pongo en la mano.
Eso era conocido.
Thank you, Marina.
Lo vamos a pagar, ayuda, ¿no? Sí. Nos llaman una vez al mes.
Ya su información y ahí depende que
Siento que pueden llegar hasta otros 2 meses, 3 meses, cuando ya está listo.
aquí uno sí tramita todas las cosas, que ya.
Está preparado. Sí, es lo primero. ¿Y cómo le
They would mention. You know, that doesn't sound confusing. Actually, it's payoff. So you don't, if you refinance it, you don't have to make a payment to it. If you sell the house, you have to pay off.
Next month, you have to pay for closing costs.
If you get a zip, get which is the closing cost assistance, or if you get the home, my home, which is the